What happens when you go from too big to fail, to just a big fail? Imagine that a country is a family where the government is a hard-working mother, and the financial sector a drunk stepdad. The hard-working mother is at work every day trying to provide for her family, while the drunk stepdad is mostly sitting at home consuming resources, sometimes having some small jobs which brings in little cash. Besides these activities, the stepdad likes to gamble, a lot. He plays all kind of games there are, with every possible risk level. Sometimes he wins but sometimes he loses, and when he loses big. And what happens when he loses? You probably guessed it already, he goes to his wife for cash. Because they are married, his wife is sort of obliged to help him, and by doing this she is forced to take away money from her children's needs and give it to her drunk husband, who goes back to gambling. But what would happen if the wife decided to divorce the husband and stop giving him money? We tend to find out in this movie.
First of all, thank you Audrey for narrating that interesting piece. Of course, this was a metaphor. We thought, animations, let's give it a try. I must say, not too bad, right? Okay, so we are not exactly going to find out what happens to the woman or stepdad. Instead, we are going to take a closer look to the root of the problem. We have a small clip by people who are good at finance, but also at animations. Enjoy!
Most major banks adopted financial constructs that were barely comprehensible and did their own trading in a bid to make fast money and earn their executives and traders millions in bonuses. This was nothing short of gambling and damaged whole economies and societies. Like back in 2008, when banks like Lehman Brothers gave credit to basically anyone who wanted to buy a house and thereby put the bank in an extremely dangerous risk position. This led to the collapse of the housing market in the US and parts of Europe, causing stock prices to plummet, which eventually led to a global banking crisis and one of the largest financial crises in history. Hundreds of billions of dollars just evaporated. Millions of people lost their jobs and lots of money. Most of the world's major banks had to pay billions in fines, and bankers became some of the least trusted professionals. The US government and the European Union had to put together huge bailout packages to purchase bad assets and stop the banks from going bankrupt. New regulations were put into force to govern the banking business. Compulsory bank emergency funds were enforced to absorb shocks in the event of another financial crisis.
That's what happened in 2008. But this was not the first time when this has happened, and it will definitely not be the last. Great Depression of 1930s. Remember that? Possibly not, because you are not 90 years old, but this depression is one of the reasons why World War II broke out. Banks play, they lose, and they grow bigger. You thought that banks were too big to fail before 2008? Well, currently the US banks alone are $4.7 trillion bigger because of the enormous money influx which they received from the federal government, and it is expected that they will grow additional $5 trillion in the next 5 years. Additionally, largest 10 Western banks made $97 billion in profit on $541 billion revenue over the course of 2004. This is more than the total revenue of Spain, Russia, and the Netherlands. With their total profit alone, they could cover all the budgetary costs of countries such as Ireland, Poland, or Colombia. In reality, only a small fraction of their profit goes into the state budget. What we want to illustrate with this is the fact that banks have been and will be a huge threat to the global economy and stability. Further on in this video, we will illustrate a possible scenario which could lead to a situation where a country is taking over its banking sector and establishing unified central bank.
How would this work? First of all, Taking over banks would not be an easy process. It would require enormous investment from the government side, large inflation, and surely a lot of unrest and resistance from the bankers. Just to simplify, let us take the United States as an example. The following scenario assumes that the 5 largest American banks have become insolvent and need a bailout from the government in order to stay in business. Additionally, we assume that the bank's assets are proportionally the same versus the total economy of the country as it is now. In order for this scenario to be possible, we also need to assume that this financial crisis is equal to the Great Depression of 1930. The 5 largest American banks have gambled with money, till such an extent that they need a government bailout. JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, and Goldman Sachs, equaling a total assets of $9.15 trillion versus the total GDP of the United States, $16.77 trillion. The government says no to bailouts, which causes huge panic within the financial sector. Stock prices and currency value falls. In the midst of this panic, the government declares that in order to save their economy, they will take over the banking sector, as this is the only viable option in order to save the country's economy. US Congress issues an order with which they seize the assets of these banks, while at the same time passing a bill through Senate and Congress which classifies the banking sector as a vital national interest industry, which should be governed by the state. Meanwhile, the US dollar has fallen dramatically, the oil prices have skyrocketed, and in order to maintain at least some value of the dollar, the American Central Bank is spending trillions, buying up the dollar and pushing US government's debt towards 200% of the national GDP. All non-USA banks are forbidden to operate within the United States, but are allowed to keep their assets as for now. After the corresponding legislation has been passed, the government takes over all the banking sector, including solvent banks. Shareholders are being promised to be compensated. The government freezes all banking operations, excluding limited withdrawals, and enforces capital controls. Special committees are put in charge, which unifies banking activities in towns, cities, and states. As the government is backing this new unified bank, people slowly regain confidence in it, and things start to normalize. The new bank is 51% owned by the federal government and 49% by the states. In order to make a decision in the bank, 65 to 70% of the shareholders must be in favor of it. And finally, banks start repayment for owners of previous banks and resume loans to businesses and startups. Other banking activities, which are not in line with core banking principles, are not being executed within.
Elaborate more now about the build-up of the bank itself. The Freedom Bank would be built up similar as the current private banks. It would store and deposit cash, give loans to people and businesses, take care of the nation's pension funds. But this bank would not take part in stock exchange activities, execute risky investments, or disclose information from the general public. This bank would be fully owned by the federal government, and the board of the bank would consist of 10 people, 3 representatives from Congress, 2 representatives from Senate, and 5 from the states. The CEO of the bank would be appointed by the President of the United States. Each representative position would have elections every 4 years, with possibility for each representative to stay on the board for 8 years. This new bank would completely change the financial sector and domestic economy. But the question is, would it change it for better or worse? Reasons why this system would be better are: there would be no more need for bank bailouts, as it would be forbidden for banks to invest in risky investments or give out unsustainable loans. Additionally, the fractional banking reserve could be heightened up to 20 or even 30%. Another large plus regarding this new banking system would be the fact that the government is the owner of the bank. Thus, all the profit obtained by the bank would go straight into the government budget. These billions of dollars could then be invested in infrastructure, education, or just to reduce the government's debt. Although bank would still have large corporate structure, the number of high-level executives would be reduced, thus saving considerable amount of money for bonuses for executives. As these banks' owners would be the people, it would be more motivated to work in the interests of population. Thus their goal would be to increase the national GDP and not the share price of the bank. But there would be also some drawbacks. This system would increase the unemployment in the banking sector, as there would be no competing bank branches through the country. The number of offices and outlets the bank has would be reduced, what would mean the reduction of many thousands of workplaces. As this bank would be considered one of the largest companies in the world, it would have a huge corporate structure, what could slow down the decision making. If there would be insufficient control of this bank from the government, it would be a place which starts working for the interests of few people and not for the country as a whole. In the end, it all goes down to the integrity of people who are in charge and their intentions. As President Andrew Jackson once said, "You bankers are den wipers. I intend to root you out, and by eternal God, I will root you out." If the people only understood the rank injustice of our money and banking system, there would be a revolt before morning. Thank you for your attention. I don't know if I need to.